Here is a summary of Realty Income's Q2 2026 earnings call transcript, focusing on the requested details. Good afternoon, everyone. Realty Income has reported a strong second quarter for 2026, demonstrating robust growth and strategic execution. Key financial metrics and performance. AFFO per share grew by 3.8% to $1.09 in Q2 2026. For the year-to-date, AFFO per share was $2.22, representing a 5.2% growth, showing an acceleration from the previous year. Investment activity. Global investments totaled approximately $2.6 billion, or $2.1 billion on a pro-rata share basis, with an initial weighted average cash yield of 7.3%. U.S. investments dominated Q2 activity with approximately $1.7 billion on a pro-rata basis at a 7.4% weighted average cash yield. Industrial assets represented about 75% of these U.S. real estate investments. Europe investments closed on approximately $400 million at a weighted average yield of 7%. U.S. Core Plus Fund acquired approximately $73 million of assets globally in Q2, with industrial assets comprising over half and retail the balance. The fund's total gross asset value reached approximately $3 billion, with Q2 acquisitions generating a 6% weighted average cash yield. This fund allows for day-one accretion to Realty Income shareholders through management fees. Portfolio quality. Investment-grade client exposure increased to 34% of annualized rent from 32% in Q1. Occupancy remained strong at 98.8%. Leasing. 482 released units generated a blended rent recapture rate of 102.7%, with renewals at 104.6%. Industrial leasing activity saw a rent recapture rate of 105.8%, and international recaptures reached 112.9%. Management's forecasts and guidance. Full-year AFFO per share increased by 2 cents at the midpoint, now ranging from $4.44 to $4.45, representing approximately 4% growth. Full-year investment volume raised from $9.5 billion to $10 billion, reflecting a robust pipeline and confidence in execution. Realty Income expects to invest approximately $9 billion of this on a pro-rata basis. Credit loss outlook held flat at around 40 basis points of rental revenue, indicating stable operating performance. Significant risk factors. Geopolitical uncertainty. While activity has improved, earlier in the year, international clients were more cautious due to geopolitical concerns. Interest rate environment. While cap rates have historically followed interest rates, competitive dynamics in the U.S. are keeping cap rates lower. High rates increase the cost of capital, which will eventually need to be reflected in cap rates. Competition. Increased competition in the U.S. from new entrants on the private side is contributing to lower cap rates. Data center obsolescence and residual risk. While the company focuses on mitigating these risks through location, capacity, and long lease durations, they remain inherent to the sector. Variable rate debt. Outstanding borrowings on credit facilities and commercial paper programs are the company's only exposure to variable rate debt, which they intend to maintain at 10% or less of total debt. Highlights. Diversified investment strategy. The company's ability to invest across capital stacks, geographies, and property types is a key driver of accretive growth. Robust investment pipeline. The increase in investment volume guidance underscores the strength and breadth of opportunities. Data center joint venture. A significant $6 billion programmatic hyperscale data center joint venture with Cloud Capital was announced, with Realty Income expected to invest up to $1.4 billion. This is driven by the long-term digital infrastructure build-out fueled by AI and cloud computing. Capital platform expansion, diversifying capital sources, reducing reliance on public equity, and enhancing the ability to fund growth efficiently are key priorities. Strong balance sheet. The company maintains significant liquidity, $3.5 billion at quarter end, projected to exceed $5.7 billion pro forma for subsequent transactions. Conservative leverage. Net debt to annualized pro forma adjusted EBITDA at 5.4x, and broad access to capital markets. Fitch rating. Initiation of coverage by Fitch with a solid A. Long-term issuer default rating recognizes the company's size, diversification, and performance. Portfolio recycling. Increased focus on reallocating capital to areas with stronger organic growth, pricing power, and value creation potential, including occupied assets when market pricing is attractive. International strategy. Continued success in Europe, particularly the UK value-add retail park strategy, is driving attractive leasing spreads and value creation. Lowlights. Acquisition cap rates. Q2 acquisition cap rates were slightly lower than the prior quarter, 7.4% versus prior, which the company explained as a mix shift towards assets allocated to their Core Plus fund, designed for longer-term returns and capital efficiency. New client rent recapture. New client rent recapture rates were materially below the portfolio average, though the blended rate across new and same client leases remained strong and consistent. Most important statements from management. Sumit Roy, President and Chief Executive Officer. Realty Income delivered another strong quarter in Q2, reflecting the benefits of our diversified investment strategy and our position as a trusted capital partner to many of the world's leading companies. Our investment activity highlighted the breadth of our opportunity set, demonstrating our ability to invest across the capital stack, geographies, and property types to support accretive growth. This momentum supports a 2-cent increase in our full-year AFFO per share guidance midpoint to a new range of $4.44 to $4.45, representing growth of approximately 4% at the midpoint. We are also increasing 2026 investment volume guidance from $9.5 billion to $10 billion as our pipeline remains robust. Across our investment activity, our scale and sourcing platform continue to be significant advantages that are difficult to replicate through individual asset acquisitions. Looking ahead, we continue to see attractive opportunities to recycle capital into assets that are better aligned with our long-term strategic priorities. We believe the industry is still in the early stages of a multi-year digital infrastructure build-out driven by AI adoption, cloud computing, and broader digitization trends. Jonathan Pong, Chief Financial Officer and Treasurer. The second quarter demonstrated our commitment to diversifying our sources of capital on a global scale while maintaining a healthy balance sheet. We continue to operate from a position of significant liquidity, conservative leverage, and broad access to multiple capital channels. Pro forma for these transactions: credit facility expansion, commercial paper program expansion, European bond offering, forward equity issuance, available liquidity increased to more than $5.7 billion. Our updated credit facility now provides for borrowings of up to $5.5 billion, an increase of $1.5 billion from the prior facility, with a 5 basis point reduction to our borrowing rate. We have issued $3 billion of new debt year to date at a blended effective coupon of 3.9% compared to $1.4 billion of debt that has matured to date at a blended coupon of 4%. Private capital has reduced our reliance on public equity markets to fund our growth. As a result, we have meaningfully lowered our public equity consumption as a percentage of investment volume, comprising only 18% of investment volume year to date compared to an average of 47% over the past 3 years. The increase in AFFO guidance reflects the underlying strength of the business in terms of investment volumes, yields, modest credit losses, the successful execution of several capital markets transactions, and our expectations for continued momentum throughout the balance of 2026. In summary, Realty Income had a solid Q2 2026, marked by increased investment volume guidance, higher AFFO per share projections, and strategic capital initiatives. The company is actively expanding its investment opportunities through new joint ventures, particularly in data centers, and is focused on enhancing its capital structure to support long-term, accretive growth.